Thank you for joining us here, Cheryl. My first question is, why is the market taking this inflation number in stride? Tyler pointed out it came in about as expected. So do we feel okay about that? It's still at multi-decades high.
Yeah, no, absolutely. It still is a very sticker shock type of number. But I do think it's what the market had anticipated generally. And from a month-over-month perspective, I do think the lower than expected increase in core was really where we're starting to maybe see some green shoots that we might be nearing the peak here.
You know, a lot of these companies' earnings reports are giving us some very interesting color, particularly when you get to the executive commentary. Even if quarters that have just recently closed were relatively strong, there's a lot of uncertainty from executives going forward, trying to forecast the second half of the year, saying it's almost as difficult to do that now as it was in 2008. So if you are an investor, is this an opportunity or is this an increased time of risk? If you have money, is it a good time to put it to work right now?
I do think it can be a good time to put money to work. I think we probably are range bound a little bit in the next, call it quarter or so, as we start to see more aggressive Fed action and as we start to see perhaps some upticks in consumer credit starting to come through. Again, a lot of uncertainty driving volatility. When we think over the course of 2022, however, I think there's a lot of positive tailwinds that aren't being reflected in market multiples today, particularly in areas like financials and more specifically spread-based lenders, which are basically the pure play on higher interest rates.
Well, that's where I want to turn the conversation, and that is why the banks, specifically with the exception of Wells Fargo, the mid-market banks, I'd say, or mid-sized banks, what are the attributes that they have that make them in this environment stand out as a stock pick?
I think there's really four key things that we look at. Number one is these are essentially spread-based lenders. That's the bulk of their business model. Loan growth is accelerating. That's going to be a benefit to top line growth in addition to higher rates. And a lot of these spread-based regional bank, large community bank type banks are going to have higher degrees of non-interest bearing deposits. So that's deposits that they get at a zero cost. Right. So that spread between their lending and deposit products is going to naturally increase here. Loan growth is accelerating. M&A has been an area that we've really seen an increase, particularly in this area of the banking system. And I think a lot of that has to do with expense rationalization and optimizing your cost base over a larger geographic footprint or product footprint.
So if I'm hearing implicit in what you're saying is this: if you have money on deposit at a bank, do not expect under any circumstances that bank is going to raise any of the rates that you get as a saver. But at the same time, they are going to raise the rates they charge to borrowers. Correct? I mean, we've gotten kind of accepting of the idea that our checking account or savings account ain't going to pay a damn thing.
I think typically what we do see is that deposit rates will typically lag lending rates, and I think that'll be true particularly this cycle given the high degree of liquidity that's flush in the system today. Mm-hmm. But on the flip side, you do have fintechs and online banking franchises that probably might be a little bit more aggressive on the deposit pricing side.
Well, that's interesting. Okay, Cheryl, thank you. Appreciate it.
Thank you.
All righty, coming up, we're going to continue our Power Lunch Travel Week. Yesterday, we booked our trip. We looked at the booking companies. Today, we hop a flight. So will this summer finally be when airline travel gets back to pre-pandemic levels? I took a trip this past week.